Very good evening to all of you. Welcome to another YouTube live session with me, Srijit Kakkar. Today we will be starting with our lesson number 15, which is the starting of the options Greek, right? So the very first Greek we will be covering today will be delta. So let's get started without any delay. Now, before we move ahead, let's get done with the formalities. Make sure you people go through the disclosure, which talks about the representation, the risk disclosure, risk involved in the market, and also about the copyrights. So we are on lesson number 15. We have already covered 14 lessons in both English as well as in Hindi. In case you have still not gone through the previous lessons, make sure you do that. The link to the playlist is available in the description, both English as well as in Hindi. So make sure you go through these previous sessions, because if you're not going through the previous sessions, you might feel a little left out as we progress ahead. So do ensure you start from lesson number one. And yes, this options course is an absolutely free course. So in case you know somebody who's interested in learning options, you can share the link with them. It will remain as a free course on my YouTube channel. So I just started it some time back. And let's get started with today's lesson, which is gonna be on delta. So, like I said, we will be discussing options Greek, and the very first option Greek we will be covering today is delta. And yes, before I move ahead, I would also request you, in case you're liking these sessions, make sure you hit the thumbs up button, like the video, and also do share it with your friends and family. Now, the purpose of using the Greeks with option. So, why do we want to use Greeks with option? So, Greeks, they allow us to measure how parameters such like the script movement, if the stock is moving up or if the stock is moving down, or maybe the underlying. Similarly, when the time is passing, what is going to be the effect of that when the volatility changes? What is going to be the effect of that when the interest rate changes? What might be the effect of that on the price or the value of the option, right? So, whenever we are planning an option trade, uh, in the previous sessions, I talked about that the options are not a single dimensional asset, option is a multi dimensional asset, right? And we talked about different dimensions. Now, all these dimensions can affect the price of the option contract, right? So when you're trading option, it's not just the move of the underlying. Even if the underlying is not moving, the other factors can change the value of that option, and that is why we need to understand how they affect the value of the option so that we can plan trades in a more informed way, in a more better way versus randomly just buying and selling options. Now, Greeks give us a greater and deeper understanding of risk and the behavior of that option trade we are getting into, right? So, we'll be able to understand the risk better and also how the option can behave because of the change in any of these parameters. Now, Greeks, they definitely make our life easier. That is what we want. And in fact, when I said that when we are planning trades using options, option is a multiple dimensional asset. So, the more number of dimensions are in my favor, the better it is for me, because now it's not just one factor which is making money for me, it can be multiple factors which might be making money for me. So, even if one of the factor goes against me, the other factors can still keep me profitable. Now, Greeks are calculated by using theoretical option pricing models. Now, this is based on Black and Scholes model, so we'll not be getting into what is the Black and Scholes model. It's a very complex system which basically is used to calculate the pricing of the options, right? So, Greeks are calculated based on this theoretical pricing model, which is called as the Black and Scholes model for the option pricing. Now, Greeks are used to fine tune the constructed trade positions in order to execute smart options trade. Now, why smart options trade? Because, like I said, options is a multiple dimensional asset. So, I would like to have as many dimensions in my favor as possible, because the more number of dimensions in my favor, the better it is for me. And that is how we are not just being an option trader, we are now being a smart option trader, trying to have as many dimensions in our favor as possible. Now, what are the different dimensions of option trading? They are generally called as, or I would say, uh, these dimensions in the options terminology, right? They are called as Greeks. So what are these Greeks? Let's understand what these Greeks are and what are their meanings. I know when somebody says delta, theta, gamma, vega, rho, you might be feeling a little confused because we are not able to recall what these Greeks they actually mean. But today, once we go through this slide, trust me, from today, anyone talks about delta, you will always know what is delta. Anyone says theta, you will always understand what is theta. I'll make it very simplified for you. So the very first Greek is basically the delta, right? So this is the symbol for delta. It is called as delta. Now, what does delta means? Just look at the very first letter. The very first letter is D, right? So D stands for direction, right? So remember The very first letter is D. D stands for direction. So, what do we mean by direction? Direction means in which direction is the underlying going. The underlying can either move up or the underlying can either move down, right? That is the only direction in which the underlying can go. So, what is delta? Delta is the impact of the script moving, right? Because the script can either move up or the script can either move down. So, when somebody says delta, you should now be immediately able to recall that delta starts with D, and D means the direction of the underlying, which is basically the movement of the script, whether the script is moving up or whether the underlying is moving down, right? So that is delta. Delta is basically the move in the underlying. The second Greek is called as theta. So this is the symbol for theta. Again, what is the very first alphabet of theta? The very first alphabet is T. So from T, remember time, right? D, direction. T is time. So what is theta? Theta is basically the impact of time passing. So like I told you that options, they have multiple dimensions. When you're buying options, time is always against you because every 24 hours 1 day is passing. So how it is going to affect my options position, that is what the theta will tell you. How the movement of that script, whether it is moving up or moving down, will affect my option position, that is what the delta will tell you, right? So always remember these first alphabets. D is for direction, which is the direction of the underlying. T is for theta, which is basically your time. The next Greek is V. V stands for Vega. So from we remember volatility, right? We talked about historical volatility, we talked about implied volatility. But if you remember, we said implied volatility is based on the options pricing. So when we are talking about Vega, which is volatility, we are talking about the implied volatility, not the historical volatility, because historical volatility is based on the underlying, not based on the option pricing, right? So here when we are talking about V stands for volatility. So the impact of implied volatility, because options pricing has it has built into it the implied volatility, which is the expectation of the crowd, what can happen in the future, not what has happened in the past, which is the historical volatility. So again, very simple to remember these. D stands for direction, T stands for time, V stands for volatility. So D, direction, is the script moving, the underlying moving. T, theta, is basically your time, which is time passing, and V is basically your volatility. And in options, we are always looking at or talking about the implied volatility. Now, these are, I'll say, the major three factors, right? So there are other Greeks as well. We'll also be touching upon them, but the main three Greeks we always want to be very careful of is the delta, theta, and vega. And even in all three of these, this one is the one to which we have to focus the most. Why? Because like when we were talking about implied volatility, we said it is based on crowd psychology, and crowd psychology can go to unreasonable extremes. So what can happen is whatever profits the delta is making for you, whatever profit the theta is making for you, maybe all that profit is taken away by vega, because vega can go to very extreme prices. So even though when the two dimensions are working for you, this one dimension can take away all the profits. But similarly, on the other side, if your vega is supporting you, then what can happen is even if you're losing money on the direction, even if you're losing money on the time, just being right on the vega, and if the vega starts supporting you, you can make money even though the stock might be going against you and the time is passing every day. So that is why it is very important for us to understand all these components when planning our trades. And like I already said, the more number of dimensions are in my favor, the better it is for me, right? So that is how it's going to be. Now these are the three which we will always be focusing on whenever we are planning options trade, but because they have the highest impact. The other two, they do not have a very huge impact, but let's also touch upon the other two. The other two is, one of them is gamma. So what does gamma stands for? Gamma stands for the change of the rate of change of delta. So what happens is delta is not constant. The delta also changes. And what changes delta? The gamma changes the delta. So as we move ahead, I know now it might start sounding a little complex, but not to worry. I try to break things into small chunks and make it as easy for you as possible. So we will be going through all these Greeks one by one. But gamma is basically the change of delta. So delta changes, but what is changing delta? Gamma changes the delta, right? So that is how it is. So when we get to gamma, you'll understand what gamma is. And the last one is rho. So what is rho? So R stands for uh, rate of interest, right? So rho is basically the impact of interest rate, right? So the only one you'll probably have to remember is G, because G does not correlate in any ways to the change of delta. But yes, R is again your interest rate, right? So that is how you can remember R. So the only one you will have to remember is gamma, which is the rate of change of delta. So how the delta will be changing because of gamma, and rho is how the option pricing will be getting impacted due to the change in interest rate. So again, just a quick recap: delta, D stands for the impact of script moving, which is the direction. T, theta is impact of time passing. V, vega, volatility is impact of change in implied volatility. G, which is gamma, is basically your rate of change of delta. And R, which is your interest rate, is the impact of change in the interest rate. So these are the five Greeks. And even out of these five Greeks, can you see I have clubbed these three together? Why? Because this is the three which impact the option pricing the most, and that is what we will always be focusing on. So today we will be covering the very first one, which is delta. And as we move ahead, then we'll start understanding theta, vega, gamma, rho, right? We'll talk about all of these, but today's session will be on delta. So let's understand what is delta. So what is delta? Delta measures the change in the options premium given 1 point change in the price of the underlying. So what delta basically tells me is, if let's say I buy a stock at 100 rupees, if the stock goes from 100 rupees to 101, or if the stock goes from 100 rupees, in fact I should have said, let's say I buy an options, right? I buy an option contract, be there anything. So let's say I buy an option contract, which is a call, right, of 100 strike when the current market price was also at 100, right? Now, if the current market price goes to 101, what is going to be the impact on that call option? And similarly, if the price goes to 99, what is going to be the impact on that call option, right? So that is what delta measures. So delta measures the change in the options premium. So let's imagine when I bought this option, maybe it was for 10 rupees. So what is going to be the premium if the price of the underlying goes from 100 to 101, or if it goes from 100 to 99? Now, many of you might think because from 100 it is going to 101, then it should become as 11 rupees, and from 100 it is going to 99, it should become 9 rupees. That is not going to happen. So that is why you need to understand how the option premium changes given 1 point change in the move of the underlying. So I hope that basically gives you a little bit understanding what delta is all about. So again, delta measures the change in the options premium. So what is going to be the change in the options premium when we have a 1 point change in the underlying asset? All right, so let's try to understand this. So calls are positively correlated units to the script, right? So that is what we talked about, that calls are positive units, puts are negative units. Calls are positively correlated, puts are negatively correlated. Now, what do we mean by positively correlated? Positively correlated unit means if the underlying goes up, the option pricing goes up. So if the underlying goes up, option prices go up. That is a positive correlation. And similarly, if the underlying goes down, the option price also goes down. That's a positive correlation. So something which does exactly what the underlying is doing, that is called as a positive correlation. And in the previous sessions, when we were discussing about calls and puts, we talked about that calls have positive correlation and puts have negative correlation. So again, it's just a quick recap. Calls are positively correlated to the underlying. So as the price of the underlying rises, the call premium will also increase. And similarly, as the price of the underlying falls, the call premium will decrease. Why? Because they are positively correlated. So what does that mean? That calls, they will have a positive delta which will be ranging from 0 to +1. Why? Because it is a positively correlated unit. So the delta will be, the minimum can be 0 and the maximum can be 1. It cannot be more than 1. Why it cannot be more than 1? If you think about it in a way, if a stock goes in my favor by 1 rupee, I can only make 1 rupee. If a stock goes in my favor by 1 rupee, I cannot make 2 rupees on that. So that is why the maximum will be 1 rupee. And in case that option is not in the money, then we know at expiry, in the money options, they do not have any intrinsic value. So that is why it's going to be 0. The intrinsic value cannot go into a negative number. So that is why it will always range for a call from 0, which will be out of the money, to 1, which will be in the money at expiry, right? At expiry it will be 1, but before expiry it can range from 0 to anywhere in between, but the maximum can be 1. Now, for Out of the money calls, the delta is approaching to zero. Why delta is approaching to zero? Because if the calls are out of the money at expiry, the intrinsic value has to be zero, right? So that is why the more you go out of the money, you will see the delta will start decreasing and it will start approaching zero. Similarly, at the money calls will have a delta which is approximately zero point 0.5. Now, why zero point 0.5? Because if you think about it, if something is in the money, it has 50% chances of remaining in the money, and similarly it has 50% chances of going out of the money. So that is why whenever we have a strike which is at the money, because it has 50-50 chances, yes, 50% it can remain in the money, 50% it can become out of the money. So that is why at the money calls will always have a delta which will be approximately zero point 0.5. So if it is exactly, so let's imagine we are exactly at 100 and the strike price is also 100 at that given point of time, it will be exactly 50, right? But if it goes a little bit above, it goes a little bit below, it might be zero point 0.05, maybe 0.001 or something like that. So generally we only get two decimal places, so it can be 0.051 or 0.052, but approximately it's going to be zero point 0.5, because when option is at the money, it has 50% probability of remaining in the money and 50% probability of going out of the money, right? So that is why they will have a delta which is approximately zero point 0.5. Now, similarly, the far in the money calls, because we know that at expiry, the only thing an option will have is the time value will be no longer there, time value will become zero, and the only value left will be the intrinsic value, right? And that intrinsic value has to be one, because if I bought a, let's say, call which is at 100 and current market price is 102, I have an advantage of 2 rupees, and I can only have an advantage of 2 rupees if my delta is 1, because if delta is 1 for 2 rupees, I have 2 rupees profit, and that is why the delta has to be positive 1 at expiry. So always remember, in the money calls at expiry will be plus 1, out of the money calls at expiry will be 0, and whatever is at the money will be at zero point 0.5. And the more we start getting out of the money, the from zero point 0.5 it starts reducing, and similarly the more we start getting into the money, the maximum it can reach is 1. So if you look at it as a graph, so this is how it would be. Let's imagine we are looking at a call with a 50 strike. So this is my 50, right? This is my 50, which is almost the center. So if we have a strike which is 50 of a call, because now it has 50% chances of remaining in the money and 50% chances of going out of the money, the delta is going to be zero point 0.5. And we just talked about that a call can have a maximum delta of positive 1 and minimum delta of 0. It cannot go negative. So what is going to happen is, the more that call starts going in my favor, the delta will start increasing, and the more it starts going against me, the delta will start reducing. So script trading at 50 causes the option to be at the money and the delta approaches zero point 0.5. Why? Because when we are trading at 50 rupees, the 50 call is exactly at the money. That is why the delta will be zero point 0.5. Now, when we start going out of the money, the delta has to reach 0. So you can see, the more we start going out of the money, the more it starts getting closer to 0. So script trading at 20 causes the option to be out of the money and delta starts approaching 0. And similarly, when the script is trading at 100, this causes the option to be in the money and the delta starts approaching 1, right? So always remember, this is what happens with delta of a call. When it starts going against us, we start approaching 0. When it starts going in our favor, it starts going to 1. So the minimum can be 0, maximum can be 1. And yes, at expiry, in the money will always have a delta of 1, and at expiry, out of the money will always have a delta of 0. So similarly, if you talk about puts, puts are negatively correlated units. Now, what do we mean by negatively correlated units? If the stock price goes up, the value of the put will go down. That's a negative correlation. Underlying goes up, option value goes down. Similarly, the underlying goes down, the option values goes up. So that is what we call as a negative correlation, right? Again, we talked about it in one of the session sometime in the past. So as the price of the underlying falls, the premium starts increasing. That is why puts are negatively correlated units. It does the opposite of what the underlying is doing. Similarly, as the price of the underlying starts rising, the premium will decrease, right? So that is what happens in case of puts because they are negatively correlated units. Now, puts, they have deltas which is ranging from 0 to -1, right? So here also, the maximum it can go is -1, minimum can be 0. Because they are negatively correlated units, that's the reason it is -1 and 0. So what is going to happen? The far in the money puts will start approaching -1 because the more we are in the money, the delta will start approaching -1. At the money, we'll always have a delta of 0.5, but because puts are negatively correlated units, it's going to be minus zero point 0.5. And similarly, out of the money puts will have delta which will start approaching 0, right? So just the opposite of what we saw in the case of calls. So now if you look at the graph will just be the opposite. So again, let's imagine we are looking at a put which is a 50 strike. So when the underlying is at 50, right? So, and again, if you recall what we just talked about, minimum can be 0, maximum can be -1. So when we are at 50, right, which is exactly at the money, what is going to happen? The script trading at 50 causes the delta of the option to be, I mean, it causes the option to be at the money, and therefore the delta will approach -5. Why? Because now it has 50% probability of remaining in the money and 50% probability of remaining out of the money. That is why the delta will be 0.5, 50%. But because it is a put, which is a negatively correlated unit, it becomes as minus zero point 0.5. Now, if the price starts going further down, which means now this is becoming out of the money, what is going to happen? The script start trading at 100 causes the option to be out of the money, and now the delta will start approaching 0 because at expiry all out of the money options will have 0 intrinsic value. So that is why it starts approaching 0. Similarly, if it starts moving to a lower price, which means now this option starts getting uh, in the money. So script trading at 20 rupees causes the option to be in the money, and now the delta will start approaching 1. But because puts are negative, that is the reason it is -1, right? So it starts approaching -1. So this is how the graph of the delta is for a call and a put, right? So this is your graph for the put, and this is your graph for uh, the delta of a call. So now let's move ahead and see what else we have. So what is the interpretation of the delta? The delta changes as the underlying moves, right? And what is changing the delta? The gamma is changing the delta. So as we move ahead, we'll also be covering gamma in one of the session, but the delta changes as the underlying moves. And this is because of the effect of gamma, representing a percentage of participation in the underlying movement. So what do we mean by percentage of participation? We'll just understand it as we move a few slides ahead. When long option, the net delta increases as the script is moving, as the script moves in your direction, creating the effect of holding more shares. So what do I mean by that? Now let's try to understand it with an example. Now, like I said, let's say we buy a call. In fact, let me just do this. Let's say we buy a call which is 100 strike, and the current market price of the underlying is also 100. So what did we talk about? We talked about that option which is at the money, because this is at the money, we are exactly at 100, will have a participation or will have a delta of zero point 0.5. Now what do we mean by zero point 0.5? If the underlying goes from 100 to 101, oh sorry, 101, which is a 1 rupee move in my favor, and let's assume when I bought this call was for 10 rupees. So if this goes up by 1 rupee, this will not go up by 1 rupee. Why? Because my delta, my participation in direction is just 50%. So what is going to happen if it goes to 101? My option will only increase by 50%, right? Which means for that 1 rupee move, I will only get 50% participation, which means the new value of that option will now be 10 rupees 50 paise, not 11 rupees. Why? Because my participation was 50 paise. Similarly, in case it goes to 99, right, the underlying goes to 99. So again, what is going to happen? Because it went 1 rupee down, so now this will not reduce from 10 to 9 rupees. This will only reduce by 50 paise because we have a 50% participation, and now this will become as 9.5. So the delta changes as the underlying moves, right, which we already talked about is because of the gamma effect, representing a percentage of participation in the underlying movement. So that was my participation, that when we are at the money, my participation is only 50%. So even if the stock goes 1 rupee in my favor, I will only get advantage of half of it. If it goes against me, I will only get uh, you know uh, it will only reduce against me by half of it, not the complete amount. Now when long options, so when we are long options, be that calls or puts, right, whether you're buying a call, whether you're buying a put, the net delta increases as the script is moving in your direction. So the more it starts going in my direction, so let's imagine we were at 100, from 100 it goes to 101 to 102, then 103, 104, because we talked about that the delta moves from 0 to maximum 1. So what is going to happen is from zero point 0.5, it will start increasing to 0 0.6, 0 0.7, 0.8, 0.9. So what is happening now is, as and when it is moving in your favor, your participation is increasing by every 1 rupee increase. So initially you might be participating for the very first 1 rupee, your participation was 50%, but now when it moves to 102, now your participation might become as 0.55. When it moves to 103, now your participation might become as zero point 0.6. So it is almost like if you were having 100 shares initially, right? As an example. So 100 shares, because you were having a participation of 50%, you were actually getting the advantage of only half of the value, which is 50. So what do I mean by that? If I was holding 100 shares, it goes 1 rupee in my favor. I don't get a 100 rupee profit. I only get a 50 rupee profit because of my participation is 50%. But now when it moves the next 1 rupee, my participation has increased from 50 to maybe 55. It moves another 1 rupee. Now my participation has increased to 60%. It moves another 1 rupee. Maybe my participation increases to 0.65. Now, when I show you on the chart, you will get a little bit of more clarity, but this is what it is talking about, that when it starts moving in your favor, it creates an effect as if you're holding more number of shares, because the more it is going in your favor, the more the delta is increasing, and more the delta is increasing, it's almost like you're holding more number of shares. Similarly, when the script starts moving against the trader, the delta starts decreasing, which creates the effect of holding less number of shares. So what do I mean by that? If it starts going against me, then the delta has to approach 0. So if it goes 1 rupee against me, now what is going to happen is, maybe now my participation becomes as 0.45. It goes another 1 rupee against me, maybe now my participation is 0.40. So what is happening here is, you are having something which is called as a dynamic delta. So when something is going in your favor, you make more money, and when something is going against you, you start losing less money. Why? Because your participation also starts reducing. So this is what happens when you are long options, be that a call, be that a put. When it goes in your favor, it has an effect of as if you're holding more number of shares, and when it starts going against you, it has an effect of as if you're holding less number of shares. And this phenomenon creates something which we call as a dynamic leverage. Now what do we mean by dynamic leverage? If I'm holding 100 shares, if it goes 1 rupee in my favor, yes, I make 100 rupees. If it goes 1 rupee against me, yes, I lose 100 rupees. But in options, if it starts going in my favor, I will be making more money. If it starts going against me, I will be losing less money, because my participation starts reducing. It can be seen as an approximate measure of probability of the option to expire in the money based on the current market conditions. So delta can also be used as an interpretation, that what is the probability of this option expiring in the money. Example, like I just talked about, at the money, we have 50% probability. It can remain in the money, it can remain out of the money. That is why the delta is zero point 0.5. Now let's imagine something is very deep in the money. If it is very deep in the money, the delta might be zero point 0.8 or maybe 0.85. So we already know that we are very deep into the money, which basically also increases my probability that this might remain in the money till expiry, and that is why it has a higher delta. So like I said, once I show you uh, the deltas of different strikes, you will have a little bit. In fact, let me do this because we are already on this. Let's look at some examples to understand it a little better. So let's say I take Nifty, right, and let's take the 31st December expiry, right? So let's take first at the money. right? I'll take at the money call. So you can see the last traded price is 13,600. So at the money call will be 13,600, right? So this is at the money. Now, if we are talking about in the money, 13,500 will be in the money, 13,550. 500 will be more in the money, right? If I take 450, it will be more in the money. Now, if you look at the deltas here, you can see the one which is at the money. Okay, let me do this. Let me just take a different color. Just give me a second. I'll just take a different color. Okay. So can you see this is where I have my deltas, right? Delta. So what you can see, the one which is in the money, which is 13,600, right? 13,600, because the last traded price is 13,601. It has a delta of 0.5, right? So which means my participation is 50%. But the more I start getting in the money, you can see this is in the money, my participation is now 0.56%. For 13,500, my participation is 0.62%. For 13,450, my participation is 0.66%. So similarly, if I go pretty deep into the money, so let's see if I bring up in the money options, and let's go pretty deep into the money. So deep into the money would be, let's say, let's take this one. I'm not sure whether we'll be getting the values here. Can you see it is showing me not applicable? So I want to find something where I might even get the value, something which got traded, let's say 10,000. Perfect. So if you think about it, can you see if you're buying a call and you're buying a call of 10,000, and we know that the expiry is just going to be on 31st of December, which is almost like 5 6 days down the line. So what is the probability that Nifty from 13,000 can go below 10,000? That probability is very less. So it has a very high probability of ending in the money. And that is why you can see now, if you talk about your delta, my delta for this is almost 0.98. Why? Because it has a 98% probability that it will remain in the money. That is something obvious because it is at 10,000 and currently Nifty is trading at 13,600. So this can also be taken as a probability of any option strike expiring in the money, right? But otherwise, you can see the more we start getting into the money, the delta starts increasing. And like I told you, the maximum the delta can go is 0.1. Now, why is it not 0.1? Because it will become 0.1 only at expiry. Similarly, even if this at expiry is in the money, this will also become as 1. So at expiry, all in the money options will have a delta of 1. But yes, still expiry, the more it starts getting in the money, the delta starts increasing, right? So that is what your delta is. Okay, so now this gives you a little bit idea of delta. Now let's also look at the other way around, right? So like I was saying, that when it starts going against you, the delta starts reducing, right? So if I again go back to my calls, right? So this is my call which is at the money. So you can see it has a delta of zero point 0.5. Now, if you talk about 13,650, it is going to be out of the money. So what is going to happen? Because it is out of the money, my delta will start reducing. So can you see this only has a participation of 0.44%. If I go to the next one, this has a participation of 0.38%. If I go to the next one, it has a participation of 0.32%. So what you can see here is the more it is going out of the money, my participation starts becoming lesser and lesser, which means if I was holding 100 shares, just as an example, if I was holding 100 shares here, my profit or loss is almost equivalent to 50 shares. But when it starts going against me, now my profit and loss will be equivalent to 44 shares. Now my profit and loss, in fact, not profit loss, because now we are talking about it is going against us, will be equivalent to as if I was holding only 38 shares. Now my loss will almost be equivalent to as if I was only holding 32 shares. So can you see when it starts going against us, we have smaller loss, and when it starts going in our favor, it is bigger profits because the delta starts increasing, and that is what creates that dynamic leverage. All right, so now this brings us to the topic of hard deltas and soft deltas, right? Because there are two kind of deltas, the hard deltas and the soft deltas. So when trading script, we speak of shares to define the position size, right? We always say I have 100 shares, I have 500 shares, I have 1,000 shares. But when describing an option, we speak of net deltas, whether we are long those net deltas or whether we are short those net deltas. Delta, in effect, represents the equivalent of position size. Like here, I was talking about if we have a delta of zero point 0.5, which means uh, my participation is 50%. So example, if I was holding 100 shares, 100 shares because they have a delta of zero point 0.5. My participation is 50%, which means 50 shares. And here we have 44 shares. Now this would be equivalent to 38 shares. This will be equivalent to 32 shares. So that is why delta represents the equivalent share position, right? That is how it is. So, since delta represents a percentage of participation in the underlying movement, 100% of participation would imply tracking the script performance 1 is to 1. So, what do we mean by 100% participation? Like it happens in a stock. If I buy a stock at 100 rupees, right? So, let's say I buy a stock at 100 rupees. If the stock goes to 101, I make a profit of 1 rupee. If the stock goes to 99, I make a loss of 1 rupee. So can you see my participation is 100% when I'm buying a stock, because 1 rupee move gives me 1 rupee profit, or 1 rupee move gives me 1 rupee loss. So that is a 100% participation. So this is called as the participation is 1 is to 1, right? Whatever is the profit, I'm getting the exact profit. Whatever is the loss, I'm getting the exact loss. But in case of options, this changes because the deltas are not 100% participation. The deltas are some percentage of that participation. So, what are hard deltas? What are soft deltas? Long one share in a script basically means you have plus one delta. And similarly, short one share in a script will means you have one negative delta, because if it goes 1 rupee in your favor, you make 1 rupee. It goes 1 rupee against you, you lose 1 rupee. And that is why this is called as hard delta. This is not changing. This will remain constant. Whatever it goes in your favor, that is the amount you make. Whatever it goes against you, that is the amount you lose. That is why we call them as hard deltas, because they remain constant. But in options, when we were talking about deltas, the delta is not constant, right? It can go minimum to zero when we talk about calls, and maximum it can go to one. So this is a soft delta, which can vary. Like I just showed you the example of Nifty, it can vary from zero to one, right? So that is why it is a soft delta. It is not constant. And similarly, puts will also have soft deltas, which will vary from -1 to 0. Even though the effect is the same, we still call them as soft deltas. And the reason we are calling them as soft deltas is because they can vary, they are not constant, right? So again, in stocks, the deltas are fixed, they are 1, which means 100% participation. In options, the deltas are not fixed, the deltas they keep on changing. For calls, minimum is 0, maximum is +1. For puts, the minimum is 0, the maximum is -1. And yes, these are called as soft deltas because they keep on changing. So if the delta of an option reaches 1 or -1, then the option effectively behaves exactly as the underlying. Why? Because now what is happening, if the stock has gone 10 rupees in my favor, my option price has also increased by 10 rupees. That is what a +1 or a -1 participation would mean, because now I have exactly the same uh, profit or loss, which basically means the same effect as holding that underlying, right? So again, if the delta of an option reaches 1, the option is now effectively behaving exactly like the underlying, because we are getting the exact participation. And again, hard deltas and soft deltas can be used as a hedge ratio. We'll also be touching upon it today, how we can also use it as a hedge ratio. And if you remember, when we did one of the sessions sometime back, when we were doing synthetics, that is where I touched upon this, that when we are doing synthetics, the reason we are doing those synthetics is because we want our delta to be 1, right? So now probably you will be able to correlate with what I was discussing in those synthetics when I was talking about deltas, right? So this is what delta is all about. Now let's take some examples. The call delta impact on the premium. So what is the call delta impact? So let's look at an option with the strike price of 9300. So this 9300 option, in fact, let me change the color. It would be much more easier for you people to see it. So you can now look at this call option at 9300. Currently it is worth 125 rupees 95 paise. But what is the delta? The delta is 0.486. So what is this telling me? That this, the underlying, moves 1 rupee in my favor. The value of this option will only increase by for 0.48% of 1 rupee, right? Which basically means by 48 paise. So if the underlying goes up or down by 1 rupee, the value of this option price will only go up or down by 48 paise. So if the script goes up by 1 rupee, the new value of the call will be 126.44. Why 126.44? Because at 9300, this was the price. I mean, whatever the price was, the current market price was at that given point of time, it was 125.95. And because now the underlying has gone 1 rupee in my favor, that is why we'll be adding. And how much we'll be adding? Because the calls, they have positive delta, so we will be adding plus 0.486, right? Plus 0.486, because that is the participation. So the new value of that option will be 126.44. So when we talked about delta, we said delta is basically the effect of direction. So you can see when it goes in certain direction, I'm not getting that 1 rupee complete participation. I'm only getting 48 paise participation, which will increase the option value to 126.44. Now, similarly, if the script goes down by 1 rupee, so again, the option value will not go down by 1 rupee, the option value will go down by 125.95 minus, because these are positive deltas, so minus positive 0.486. So this minus this is going to be 125.46, right? So this is the participation. So this is just an example how the delta will be impacting the options premium. Similarly, when we talk about puts, in puts, we talked about that the deltas are negative. So that is why you can see now the deltas are given in negative. So again, if we take an example, the 9300 put is worth 121.90. So you can see this 9300 put is currently worth 121.90. Now, if the underlying goes up or down by 1 rupee, what is going to be the impact? So if the script goes down by 1 rupee, the new value of the put will be 121.9, right? Minus 0.519. Why minus? Because puts, they have negative delta. So what is going to happen? Minus minus will become as plus. So the new value of that put will be 122.42. So because of that 1 rupee move, my participation or the option price did not increase by 1 rupee. It only increased by 51 paise because the participation was 51%. Similarly, if the script goes up by 1 rupee, right? If the script goes up by 1 rupee, the new value will be 121.90 plus minus 0.519. Why? Because again, it's a negative delta. So this is going to be this minus this, which will become as 121.38. So this is how the delta gets affected because of the move in the underlying. So, like I was also saying, delta is also the measure of expiring in the money. I just showed you an example of it. It's exactly the same thing. The 9300 call net delta is suggests that we have 48% probability. So, if you look at this call, which is 9300, currently the delta is 0.48, so it is almost close to being at the money, right? But yes, it can remain out of the money, it can remain in the money. So this is basically what the value is. So it has a almost 48% probability. But similarly, if you look at the 9000 put, here you can see the put, which is the 9000 right here. 9000 put has a delta of 0.18 because it is out of the money, which is basically telling me that only 18% probability maybe it might get in the money, but that probability is less, and that is why it also has less of delta. So the greater the delta, the greater the theoretical probability of expiring in the money, and similarly, the smaller the delta, the smaller the theoretical probability of expiring out of the money. Now, like I was saying, delta can also be used for hedging purpose. Now, let's understand as an example. Let's say a trader is long 150 shares of a script in actual long 150 script is actual long 150 hard delta. So if you are holding 150 shares, right? So we talked about that underlying or the stocks, they have a hard delta, and that delta is plus 1, right? In fact, I should say the delta is 1. So because I'm long, so I am long 1 multiplied by 150 shares, which means I'm long positive 150 deltas, right? Because the stock has a delta of 1, which basically means if the stock goes 1 rupee in my favor, I make 150 rupees. Stock goes 1 rupee against me, I lose 150 rupees. So that is why we are 150 deltas positive because of a long position. Now, if the contract size is 75 shares, right? If the contract size is 75 shares, what is going to happen is buying 4 of 9300 put would provide us a minus 155.7 soft deltas. Why? Because if this is my delta and I want to hedge my position, for hedging I should have exactly the same delta or maybe somewhere around close to it. So how can I have exact same deltas? If you look at the 9300 put, right? Because I want to hedge it, so that is why I'm buying a put. So when I'm buying the put basically means short position, because my participation is 50%. So what I need is, if I will be having 300 shares with me with the 50% participation, only then I have 150 delta, right? So that is the only way I can have 150 delta. So that is why what you'll have to do is you'll have to buy four contracts. Why? Because the contract size is 75. So if I buy four contracts, I'll be having 300 shares with the participation of 50%, which basically now gives me a minus 150 delta, and my position is hedged, right? So this is how we do it. So minus 155.70. How did we get 155.70? Because we are taking four contracts. Currently the delta is minus 0.519, and because the lot size is 75, we are multiplying with that, and that is how we got this. And now you can see that we were long 150 deltas, and now we are also short 150 deltas, a little bit more, because we know we cannot fix this lot size. The lot size is already fixed, we cannot change it. So we are trying to get very close to it, so we are almost at zero deltas now, right? So that is how we hedge it, and that is why we talked about that delta can also be used for hedging purpose. So just because you have 150 shares does not mean you buy two contracts, because if you're buying two contracts, yes, in a way you have 75 shares plus 75 shares, but your participation is 50%. So what is going to happen is the 75 again boils down to only 75, because my participation was 50%. So that is why instead of buying two, I would have to buy four puts, because now this makes it as 300, and 50% participation of 300 basically gives me a negative delta of 150, which is equivalent to my hard deltas, and now my position is hedged. All right, so the position is hedged now, and perfect. That brings us to the end of today's session. But before we end the session, let me also show you a few more examples of these deltas. So I just showed you example of Nifty. Let's say we go to Reliance. Oops. So if you look at the last here, symbol not found, let me try again. Perfect. And let's go to 31st of December. Why am I not getting? Okay, because I've only selected at the money. Perfect. So let's bring up in the money, out of the money as well. So now if you look at it, can you see the last traded price of Reliance is 1947. So what is my nearest strike? My nearest strike is 1950. So this is a strike which is at the money. So what is going to be the delta of at the money? It should be close to zero point 0.5, right? Because it's exactly not 47, it is 50. So you will see that will be very close to zero point 0.5, and you can see the delta is zero point 0.5. Maybe if you were getting three decimal places, four decimal places, this might be 0.50012 or something like that. But yes, as of now, you can see we have 50% participation, because this is at the money. Now if you are talking about calls which are in the money calls will be calls which are cheaper than this. So if I take the next call, the delta will be a little higher. You can see it has a delta of 0.69. If I take the next call, it will have even further higher delta. You can see 0.86. So what that basically means, that if I am buying this call, for every 1 rupee the stock goes in my favor, my option value will increase by 86 paise. But if I'm buying this call, for every 1 rupee the option goes in my favor, my participation or my option value will increase by 50 paise. Now, similarly, if I go out of the money, what is going to happen? My participation will start getting lesser and lesser. So if I go out of the money, I go for a call which is 2000, you will see it will be less than zero point 0.5. It is only zero point 0.3, which means uh, if the stock goes against me by 1 rupee, right, I will only be losing 30 paise. I'll not be losing 1 rupee. But similarly, if the stock goes in my favor by 1 rupee, I'll not be making 1 rupee, I'll be making only 30 paise. So now this brings me to a concept which a lot of people they make a mistake. So what people they make a mistake is, let me take an example of a demand zone. So let's say I have a demand zone, and let's say that demand zone is exactly at 1950, right? So let's say this is where my uh, distal line is, let's say 1950, right? So what people they generally do is they buy a out of the money call. Why? Because from demand they are expecting prices to move up. So what they'll probably do is maybe they'll buy a call which is at 2000. Now why they will buy a call which is at 2000? Uh, because if you think about it, what is happening is if I buy a 1950 call, the 1950 call will cost me, you can see the last traded price is 37 rupees. But if I buy, okay, let me do this. Let's say I buy a 2100 call. But if I buy a 2100 call, you can see it is at 5 rupees 75 paise. So can you see for this one, I will have to pay 37 rupees. For this one, I will only have to pay 5 rupees 75 paise multiplied by whatever is the lot size. So what people they do is they buy something which is cheap, right? So they feel, okay, I'm buying something cheap. What is going to happen is if it starts going in my favor, yes, then I'll make more money, but I'll have to invest less capital here. But if you think about it, this is not giving you any advantage. Why it is not giving you any? I mean, it might give you an advantage once it is going above 2100, but unless and until it goes above 2100, what is the challenge you are facing? If you try to understand the challenge is if I buy this 2100 when prices are in my demand zone, if it goes 1 rupee in my favor, my option price will only increase by 10 paise, right? So it's like if I'm going from point A to point B, now you're trying to go by a cycle because your participation is less. So even though the underlying went 1 rupee in your favor, you did not make 1 rupee. Why? Because you wanted to go for a cheap option, but that cheap option had its own downside, and that downside was your participation is just 10% of it. So even if it goes 1 rupee in your favor, you do not get the advantage of 1 rupee, you only get advantage of 10 paise, right? And the only reason you did that was because you wanted to buy a cheap option. But if you remember when we talked about how to select the strike, we talked about we will always choose the strike which is at the money or maybe in the money, never out of the money. Now what is the reason for that? The reason is if I'm going for this 1950, yes, I will have to pay more premium, I completely agree to that. But now my participation is also for this 1950, you can see my participation is also 50%. So for every 1 rupee it is going in my favor, I'm at least making 50 paise. But in this case, for every 1 rupee it is going in your favor, you're only making 10 paise. So that's not a smart thing to do, right? I'm betting on the direction, and even after betting on the direction, I'm not trying to take the maximum advantage of that direction. I'm only taking 10% advantage of that direction. Here, at least, I'm getting 50% advantage of that direction. So that's reason number one. Reason number two, if you are buying this option which is out of the money, what is going to happen is in case it starts going down, this will also not change a lot. Why? Because at expiry it has to be zero. So something which is already at point 1, what is going to happen in case it starts going down, maybe it will still remain as 0.11 0000. Let's imagine it was 9. So what is going to happen, it goes against you, it is still 0.1100, maybe 6 or something like that. So what is going to happen is if it is going against you, you are still losing uh, almost the same kind of participation. But if I was taking this option which is at the money, as soon as it starts going against me, because it has to reach zero, its participation will start reducing faster. So here the participation will not reduce faster, but in case of at the money, your participation will start reducing faster, which basically implies in case it hits your stop loss, you lose less money. In case it goes in your favor, you get more of the participation. But in case of this option, it goes in your favor, you have less of the participation. Only when it comes to 2100, then your participation starts becoming 50%. But in this case, if it goes to 2100, when you were buying that 1950, maybe by 2100, your participation is already 85%, 89%. And similarly, if it goes against you, you are still not reducing your participation very fast because at expiry it has to be zero. So your participation will still remain uh, whatever the number was. But in case of this, it starts going against you. Your participation also starts going to a lower value in a very fast speed, right? So that is why you always have an advantage when you are buying an option which is, I mean, if you're choosing a strike which is at the money, right? When you're buying options, because if it is at the money or in the money, both ways, in case it goes in your favor or in case it goes against you, your participation starts becoming faster, right? So that is why don't do, which I will say a lot of people they do. They are only looking for cheap options, but now you can see what is the challenge. If you're going for that cheap option, yes, the option might be cheap, but the problem is that cheap option will only give you a cheap participation in that script move. So, example, even if the script goes 5 rupee in your favor, your option price might not increase by 5 rupees, because by the time it comes to 2100, it has to be 50% participation. So that is where you lose on the money which you could have made on the direction, because your participation, you're starting with a very low participation. All right. So yes, I also wanted to touch upon this. So we have already talked about it. Why uh, it is not the right thing always to look for cheap options when you are trying to buy maybe calls, maybe puts, because going for a cheaper option which will always mean you are going for an out of the money call or out of the money put, and out of the money call or out of the money put will always have lesser participation. So even if it goes in your favor, you don't get a lot of advantage. Your advantage is a very small advantage, right? Plus, in case it goes against you, you also do not lose. I mean, the participations does not start reducing very rapidly, so you still lose almost the same amount. But in case of at the money, it will react much faster, and you lose a little less versus if you were doing the same trade using an option which was out of the money option. All right, so that basically takes care of today's topic, which is delta. I know it's a little complex initially, and that is why I said, I'll be breaking these things into small little chunks, so you can go through this session twice, thrice, try to understand what delta is. But again, just to recap and make it very simplified, delta is your participation for every 1 rupee move of the underlying, and at the money option will always have a delta of zero point 0.5. The more you start getting in the money, the delta starts increasing. The maximum it can go for a call is 1. And the more you start going out of the money, the delta starts reducing to 0. And at expiry, in the money options calls will always have a delta of 1. Out of money will always have 0. Similarly, in case of puts, the at the money will be again a participation of 50%, but because puts are negatively correlated, this is going to be minus zero point 0.5. In the money, as you start getting more and more in the money, the maximum it can go is minus 1, because again it is negatively correlated. And out of the money, minimum it can go is 0, right? So that is what delta is all about. And like we when we were talking about Greeks, D stands for delta, D stands for direction, and this is what direction basically tells you: how much participation you'll be having for every 1 rupee change in the underlying. Now let me also give you an example of a put, because we only looked at the example of calls. Let's take a quick example of puts, and then we'll be closing the session. So let's take some put examples. So if I'm looking at a put which is at the money, so again this is 47, so 1950 will be at the money. So you can see even in case of put, my participation is 50%. Now what is going to happen is, the more I start getting in the money, you will see the put will start, sorry, in the money would be right here, right? So the more I start getting in the money, I've already taken 90/50, so I'll have to take 2000, right? So you can see the more I start getting in the money, you will see my delta starts increasing. From 70 it went to point, from 50 it went to zero point 0.7. If I go to the next one, you can see it went to 0.85. If I go to the next one, you can see it went to 0.89. If I go to the next one, you can see it went to 0.88, right? And similarly, the more we start going out of the money, right? So if I take out the money, you can see 1900, this will start reducing. So from zero point 0.5 it came down to 0.29. If I go to 1850, you can see from zero point 0.5 it came down to 0.15, right? So it's the same thing. It's just that the minimum will be 0, the maximum will be minus 1 in case of puts, and in case of calls it is going to be from 0 to positive 1. All right, so that takes care of our delta, and we have covered the very first option Greek, which is delta. As we move ahead, we'll also be looking at other Greeks as well. And yes, this brings us to the end of today's session. Again, I'll add, if you're liking these sessions, make sure you hit the like button and share it with your friends, share it with your families. If you know somebody is interested in learning the options course, this course is absolutely free. In case you have any questions, queries, you can definitely put it in the comment section. I'll try to answer the questions as soon as possible. So, right, I'll see you probably on Friday now, where we'll be taking the same topic in Hindi. Till then, trade safe, enjoy your Wednesday evening. Take care. Bye bye.